Hello, this is Ernest Osias, Director of Market Analytics with Woodall Risk Management. Thank you for joining us for our weekly technical overview of the grain markets. Before we begin, a brief moment to look at our market disclosure. This is a solicitation, and there is substantial risk of loss in trading futures and futures options. Past performance is not necessarily indicative of future results. Thanks once again for joining us for our weekly installment of the Technical Market Overview. We'll go ahead and begin. The grain and crude oil markets have made for quite the wild ride this past week. And as we take a look at how the markets have reacted, we'll see how some of the key support and resistance levels held up and how we can respond accordingly. We'll first begin with the May corn contract. And after having made its low off of volatility-based support, we saw actual continued strength as the market now has made its way up to volatility-based resistance. We now have a very key level at 386. And at this point, at this 360-degree mark, if the market's actually able to get above this number, we have a projected minimum price objective of about 405 and possibly 410. Part of the reason for this is that we're noticing a potential continuation pattern that is occurring right here. When the market makes a move in this fashion, what we'll typically see is the move that the market made coming up into that continuation pattern is what it will do on the other side, which lends itself then to actually making a move up to that 405 to 406 number. Putting orders out about the 406 to 410 number is potentially a good option for us if we're a producer. But in doing so, we want to make sure that we're also hedging ourselves and perhaps capturing a minimum price objective near this 386 number as well. Currently, prices are about at 386, 385 and 3/4, and we'll notice that market has come right into our key resistance level here. So again, if the market's able to break through, we're looking for price objective just above or just beyond. And what we would essentially be looking at is a price move up to that 405 to 410 number that we spoke of before. One of the key confirmations that we're looking for is if the price action is able to close above 396 and a quarter, which is our point of control level, that would lead us to believe that that 405 to 410 number can in fact be hit. We don't want to be over optimistic here, so really the prices that we're looking at right now are very good, and in all likelihood, given the narrative of the bearish fundamentals, price action should continue lower for all intents and purposes. December corn paints for us a very similar picture. We're up against volatility-based resistance right now, very close to our 45-degree mark. And now, just overhead, we have our 360-degree mark. If the market's able to make a move in a similar fashion in the other side, then we're looking at that same 405 to 410 number on the backside. Part of our potential concern that we're seeing here is that the market is overbought. And when the market's overbought, if this continues to find momentum or find strength, the market could very well turn over from where it is right now. But given the nature of the strength that we've been seeing, that's not necessarily probable. What we can look for is for the market to kind of start to taper off into our April 26 potential timeline. And it's at this point, whether or not we've made it to that 405 or 410 number, we would suggest perhaps that this is a nice time factor for a top to come in, and at which point the market can then give us a nice little correction. Given the graphic for our natural support resistance levels with these angles here, you'll notice just overhead we have very good resistance up against this natural blue trend line that we've marked off. And we also see that our April 26th date comes back in with another piece of analysis. Now, point of control sits at 391 for the December contract. Prices are currently at 396. And then we have our next two key demarcation levels at 405 and a quarter and 421 and a quarter. So this move right here is really bullish in nature, but the market is a bit overbought, and so we'll see how he responds out of here. Volatility is increased, so really being able to capture price action or capture profit into strength would be to our advantage. The May soybean paints a similar picture. We'll notice this continuation pattern right inside of here. And what we're looking for is for the market to do on the other side what it did coming into it. Now, before it did that, we did speak about last week how this market would look to resolve itself out of this consolidating, creeping trend. We suggested that the market would perhaps come in, make a low, make a higher low, and then explode to the top side. The market actually did explode to the top side even more violently than we anticipated, as it makes its move right into our 270 degree mark. Upon coming to this level, it then consolidates again, and now we have the same pattern coming up ahead. Now we have natural resistance here, and we have the $10 mark or 1002 as key resistance at the 90 degree mark. If the market's actually able to make it through this 1002 number, then we have a minimum price objective of about 1020. But again, we don't want to be presumptuous here, as the prices are very good. It's probably in our interest to lock in some pricing here and then to see what the market might do as it progresses higher. We are looking timeline-wise for the market to continue up potentially and then make a pullback over the next couple weeks with one more final high that should top going into late May, and at which point then the market should look to make a very significant decline going into the summer months. Now, by the time this price action occurs, this May contract would have come off the board, so we can translate the information into the deferred contracts. Here we have 985 is our key point of control, or at least 2 standard deviations above the point of control, and that is potentially looking to play a role as potential resistance overhead near term. But really the market has been very strong technically, although the fundamentals still continue to be weak and continue to be bearish. On this November chart of the beans contract, we actually highlighted in advance where that consolidation pattern occurred. Yesterday, or over the past couple of days, we were looking for potential entry near this area where the market could break out for a near-term objective of about 1020 or so. Initially, the market did break out very nicely, and we see a bit of profit taking today after that big advance. Depending on how the market continues to progress going forward is going to be very key, but we are noticing some key resistance here at the 360 degree level, which is to be expected at those key demarcation points we've shared with you in the past at both the 180 and the 360 degree marks. We have a potential turn or pivot opportunity around May 19th, which is in line with where we're looking at for market cycles, for the market to move up, drop back down, make another advance, and then come back in again. And so looking at the May 19 date where the market pivots is going to be very important for us. Given the nature of the recent violent moves that we've seen in this soybean contract, we've adjusted the look back period to capture more of the previous data to give us an even more crisp view of where our point of control now lies, given the nature of how the movement has blown through our previous levels. You'll see here that our new point of control sits at 959 and 3/4, or essentially at 960. And at that 960 level here, we'll notice that this is where the market found its energy. Now, in the past, we've shared with you how when the market goes from point to point, from standard deviation to point of control, etc., as it makes its way through those levels, the space in between become vacuums where price can actually move very rapidly. So you'll notice inside of here that once the market was actually able to break through this point of control level, it finally was able to make a nice move up to the next key level where it consolidated, and now it's making another vacuum move throughout. Our next key level then sits above at 1026 or 1025 half. At this point, we believe the market will find very good resistance, and it's here that we can see a correction and then potentially one more leg up. And so we want to keep these levels at the forefront of our minds when we're looking at these price action at these levels. But we want to also be careful because we can see lots of volatility occurring in between these zones as well when they start to spread out like this. July wheat has been a bit of a surprise in that it broke topside as opposed to breaking to the downside. We'll refresh your memory and we'll see here how the 180 mark and previous support were holding very well. Market came in when it was oversold, and you can see a very nice uprun that actually came straight through our 180 degree mark. When the market makes its way through that 180 degree mark in this fashion, it indicates to us that a minimum advance to the next key level is probable, and so we're looking at a minimum price objective of about 510 for this July contract. It's moving very nicely. It had really been consolidating. Again, the fundamentals point to continued weakness, but you can't fight the chart. So when the technicals tell you otherwise, you got to run with what we see in front of us. And so currently we have a nice price objective of about 510. And if we find continued weakness at this level, then we can see a nice move back down afterward. Interestingly enough, it is when prices were able to get through this point of control number of 482.5. It made a breakaway straight through that 487 number, and now we basically sit at about 500. And the next level, one standard deviation above the point of control, sits at 519.5. But we do believe that that 510 number is going to be the key level for this July wheat contract. Finally, we'll have a look at the crude oil contract. We saw a very nice movement coming into that April 8th date that we had discussed previously. Over the weekend, some of the major oil producers met, and on Sunday they were not able to come to agreement with production. The market then actually gapped down on Sunday coming into the Monday market open, but really recovered all of those gains, and interestingly enough, support came in exactly at our previous support band. Market has then bounced from there, and even when it's found weakness before, we have a small inside day today. It's recovered much of those losses, and you'll notice that the next level that it's holding is that 180 degree mark of support. This tells us that the market still has a very good chance of reaching our potential goal of about 44, and it's at this point that we believe that the market will find some reasonable weakness. You'll notice also that our volatility-based resistance overhead is starting to band right at that number, and so if the market comes in, what you'll notice is a key 5-wave Elliott pattern, where we have wave 1, which is the initial impulse coming into the market. Wave 2 would come inside of here. Wave 3 would be here. 4 is our low, and then we would have one final push up. And you'll notice here that wave 4 oftentimes is a bit of a consolidative, choppy move that shakes people out. So this would be very consistent with the Elliott wave sequence, giving us a final top potentially near about the 44 mark, and even perhaps just above near 46 or so. Once and if that occurs, we're looking at a couple key demarcation timelines. We're looking at about May 23rd and April 28th as two potential turning points for the market here. So as this plays out, we'll keep our eye out. Obviously, this contract is going to be coming off the board soon, so we would be translating this information forward to the next contract. Thank you so much for joining us for our weekly market update, and we look forward to updating you next week.